Welcome to the Ncast Monthly Regulatory Brief. I'm Aileen McDonough, your host and Director of Content Marketing at Ncontracts. In this podcast, our compliance team provides an overview and analysis of the latest regulatory changes for financial institutions, along with info on trends to help you keep up with the rapidly evolving nature of compliance. Let's get started.
Good afternoon. My name is Stephanie Lyon, Vice President of Compliance at Ncontracts. Joining me today to deliver our regulatory Ncast is two of our sharpest regulatory compliance counsels, Brosh and Nicole Upshur. The way we're going to deliver this is going to be topics that affect the entire industry. Then we're going to move into topics that affect depository institutions like banks and credit unions. And we're going to end with topics affecting mortgage companies. To kick it off, we have Nicole talking about one of this summer's most prevalent topics, and that is fair lending. Nicole, take it away.
Thanks, Stephanie. And thanks for that sharp comment, too. I really appreciate that. So two big things happened with the fair lending space. The Federal Home Finance Agency, on July 9th, they issued a fair lending policy. In their fair lending policy, they stated that they're going to be focusing on monitoring, on supervisory examinations, on information gathering and enforcement of fair lending laws. And they're going to focus that on their regulated entities, which are Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. So you may be wondering what prompted this policy statement. One, we have a new administration and a new structure at FHFA, and they both have said fair lending is a priority. But I think most importantly, what's prompted it was the 2020 Home Mortgage Disclosure Act data that came out and showed the majority of loans that the enterprises purchased were for wealthier, high-income borrowers that lived in majority white neighborhoods. So this shows that the enterprises have some fair lending issues, and FHFA wants to come in and clean them up. So why is this important to you? If you're an institution that does business with Fannie Mae, Freddie Mac, or you're a member bank of the Federal Home Loan Banks, you can expect a trickling down effect. You agree when you do business with these entities that you will be in compliance with fair lending laws, and also that you open yourselves up to audits and examinations. So just make sure your policies, your procedures on fair lending, and your training is in place, up to date, and that you train your staff well enough so you don't fear any fair lending complaints coming against you. The other big issue that occurred with the FHFA is that they eliminated their adverse refinance market fee. The elimination of this fee is going to save borrowers thousands of dollars. So it's a win-win situation for lenders and borrowers. This becomes effective on August 1st. And one thing that is good to note is that the House Financial Services Committee issued a statement saying that they see the elimination of this fee as a great step forward for the FHFA, improving their fair lending compliance, because the fee showed that it negatively affected borrowers of color and low-income borrowers.
Thank you, Nicole. I'm pretty sure all of the industry is rejoicing at that comment and that announcement. So we're going to turn it over to state law issues here that affect the industry. And I'm going to talk about Florida. So I know it's not California this time, it's not New York, but they did just issue a pretty comprehensive Telephone Consumer Protection Act, which they dubbed it the mini TCPA. And you might be wondering, why do I care? We already have federal laws regarding calling consumers about telemarketing messages, texting them, and all that kind of good stuff. But when it comes to Floridians, they are tired of telemarketing phone calls, and the government in Florida heard them, and they decided to help them, and they passed a right of action where plaintiffs can actually pursue people who are violating this law or this act for $500 per violation, as well as attorney costs or fees and the lawsuit costs. So it is a pretty substantive penalty for accidentally dialing a consumer that lives in California. And you definitely want to make sure you're identifying if your financial institution has Floridians in your databases. So the law does exclude supervised financial institutions, but like anything in Florida, that's not straightforward. A supervised financial institution is defined as a credit union, a commercial bank, trust companies, among other businesses. But is your state bank a commercial bank? I don't know. We're going to have to figure that out. And that is part of why this law is important for us to talk about here today. Because if you are calling consumers, or you have a third party that's calling consumers on behalf of your institution, you definitely want to figure out if the scope of this law is going to affect your operations. And the second thing you want to do is you want to make sure you're observing your compliance program regarding telemarketing messages. Remember, text messages, phone calls. Are you doing automated calls? All of that matters here today, not just on the state law, but also on the federal law. And where we have the biggest split here is the definition of an automated dialer. I believe, Robert, you may have called or mentioned about what is this definition. And we talked about a Supreme Court case that restricted the definition under federal law. Well, now we have a state law that has not been equally restricted in its definition of this type of system. So that's why it's important to keep track with these types of regulatory changes and differences from state to state. We're going to move on to our depository issues, and we're going to start with climate risk. And I know, Robert, you have a lot to say, not just on the federal side, but now on the state side as well.
That's right, Stephanie. Yeah, so the Washington State Department of Financial Institutions issued an alert this month to emphasize the important role that financial institutions play in addressing climate change. So as a reminder, this alert comes on the heels of President Biden's executive order on climate-related financial risk, which really recognized the threat that the climate crisis poses to the economy and also the financial banking system as a whole. Washington's alert doesn't really establish any new rules or guidance, but it's meant to alert Washington state financial institutions to begin discussions on how to integrate climate change risks into their governance, risk management, and also strategic business plans. And then also, while we're in the vein of environmental, social, and governance issues, definitely one of the emerging risks of 2021, I just wanted to note that we at Ncontracts have received a greater uptick in client interest concerning vendor diversity inclusion. So I wanted to mention, just as diversifying your own selection of third-party vendors is important, as is diversifying your own organization, so too is paying attention to the initiatives that your third parties have in place for their own organization. I definitely think this will be a hot topic in the future. New York just released an initiative to promote diversity, equity, and inclusion at financial institutions. And we've also seen federal regulators take a much greater interest in the past months. So DEI is definitely something to pay attention to for the remainder of 2021 for sure.
That's a great point, Robert. And on the topic of ESG, I just want to say the OCC recently made an appointment to a brand new office, which is the Chief, I believe, is Climate Risk Officer. It's a brand new thing that wasn't in there before. So clearly, it's not just the states that care about this or the SEC. We have our federal agencies that regulate and supervise our institutions starting to really pay a lot of attention there as well. So thank you for that update. We're going to move on to things from Congress. And in this case, we have Congresswoman Maloney from New York, which actually, Nicole, aren't you from New York?
I am, yeah.
So your Congresswoman has just recently introduced an overdraft bill. And this overdraft bill, to be honest, has been introduced over and over and over again since 2009. But what I wanted to say about this overdraft bill is it is extremely restrictive, and we need to be paying attention to it because we have a Democratic-controlled House, we have a Senate, we have the White House. We just went through a pandemic that affected our consumers' finances strongly. So it might be the right time to bring up this overdraft bill. The overdraft bill is seeking to limit the number of overdrafts you're able to charge or impose on your consumers. She's seeking to impose that or limit it on a monthly basis as well as on an annual basis. And we know about the lawsuits about overdrafts where financial institutions were getting in trouble for ordering overdrafts so that you could charge more fees. Well, this bill is also targeting that practice and would make it illegal. So I just want to pause you right there and say, this is not anything you need to go run and take action on. It's a proposed legislation. We see hundreds, if not thousands of these come across our desk, and most of them don't make it out. Washington can't even agree if it's a nice day in the city today or not. They really can't. So I wouldn't be too worried about it yet, but it is definitely, like I mentioned, it's right time for something like this, especially in light with, as we talked about, DEI inclusion and how some overdraft fees have been impacting specific types of borrowers and specific types of depository people more than others. So definitely let's look at that and make sure that we are talking about it, because non-interest income is very, very important for financial institutions. All right, so let's go to the White House, Robert. What is going on in there?
Yeah, so President Biden is calling on the Justice Department and federal regulators to tighten their scrutiny of bank mergers. The move is really part of a broader executive order meant to promote competition across the United States. But in my mind, this executive order really goes hand in hand with others out of the Biden administration, namely the memorandum on redressing the nation's history of discriminatory housing practices, because communities of color are disproportionately affected by bank closures that are very often the result of mergers or acquisitions. And emphasized throughout the executive order was the fact that federal agencies haven't formally denied a bank merger in more than 15 years. So I certainly think that they're not messing around. They're gonna pay a lot closer attention to proposals for bank mergers on the disparate impact that it can have on communities of color and minority communities overall.
And that is not all that we have from President Biden, right, Nicole?
Right. I mean, this was a big executive order with 72 different initiatives. And like Robert said, another initiative which may be important to our financial institutions was Biden calling on giving consumers greater control over their financial data by improving data portability. In this executive order, Biden states that he wants to make it easier and cheaper for consumers to switch banks by being able to take their financial transaction data with them to a competitor. Biden also calls on the Consumer Financial Protection Bureau to issue rules to implement data portability. So what does this mean for financial institutions? Right now, it means to be on the lookout on the horizon for the CFPB finally implementing rules under Section 1033 of the Dodd-Frank Act. So once these rules are implemented, it may change your current data access policies that you have for consumers. So you want to look at the type of data when you give consumers access to that data, because this may be changing. Another thing to note is this may be a jump start here in the States for what's been coined as open banking, which is already occurring in Europe and other places overseas.
Perfect. And you're not wrong. Data portability, data security, cybersecurity, we can't stop talking about these things week after week, month after month. It just seems to keep coming. So, all right, we're going to move on to topics affecting our banks. And I'm going to start with something that is near and dear to all of us here today at Ncontracts, and that is proposed vendor management guidance. It was like opening a present for us here at Ncontracts because it was our flagship product and vendor. So we are definitely always monitoring any developments when it comes to vendor management. Unfortunately, it wasn't anything revolutionary. It wasn't anything out of the world or unexpected for us. what the agencies are trying to do, and these agencies are the OCC, FDIC, and the Federal Reserve, or the Fed. They're deciding to finally come together, as Robert likes to call it, bringing the band back together type of situation. And they are trying to make sure that they can streamline all of the guidance that's out there regarding vendor management. So the Fed and the FDIC, they have very different ways of defining a critical vendor, what is something like a third party, what is considered to be an affiliate. We want to make sure that when they examine financial institutions and banks, that they do it in a way that makes sense for everyone across the industry. And they are taking the approach to issuing interagency guidance. So this is the first type of proposal to bring them all together so that this vendor management topic is carried across and executed in a way that makes sense across all of these agencies. The gold standard in vendor management guidance is the OCC. So that is the guidance that most of the other regulators are going to be looking at. And that is what's been proposed as the backbone or the framework for our vendor management guidance for all banks. And they are thinking of introducing not just the guidance that's out there from the OCC, but FAQs that they also issue and continue to feed throughout the years. So if you're interested in commenting, if you want to know what's in the proposal, take a look. But we're going to be having to wait until that final guidance is out to really analyze it and decide if there's anything truly changing that is worth mentioning here in our Ncast for next time. On that note, let's move on to, again, more interagency guidance, this time the CRA, and that would be Robert.
Thanks, Steph. Yeah, you stole my thunder there with getting the band back together, but I won't hold it against you. But yeah, so back in May, or back in our May Ncast, I think I mentioned the discussion concerning the Community Reinvestment Act and how the OCC had broken away from the Federal Reserve and the FDIC last year in implementing regulations to modernize the CRA. Well, it turns out the OCC is actually backtracking on its 2020 rules and plans to rescind them sometime soon. And in turn, the OCC, FDIC, and Federal Reserve have announced that they are going to be working closely together to create a joint rule. And I'm really glad to see this, honestly. Again, I think it's important that we regulate institutions based on their operations and activities, not the charter that they choose. Plus, combining the resources of all the agencies should allow for the creation of more robust CRA regs and also hopefully give institutions a more concrete understanding of what exactly is expected of them. So the band is, in fact, getting back together, yes.
We don't know exactly how yet, but something is happening there. That's the exciting part. All right, Nicole, I know we just talked about data portability, but what are the states thinking when it comes to model privacy or data laws?
Okay, so data is a big issue with the federal government and the states. We have a model state data bill, which was proposed and across the board rejected by the American Bankers Association and 49 other state bankers association. It was proposed to the Uniform Law Commission, and the reason that the American Bankers Association and 49 other state banking associations are rejecting this bill is because they feel that it doesn't protect banks. It doesn't give banks enough exceptions, and it doesn't follow the existing federal framework. So they just feel across the board the model bill is insufficient. One of the reasonings about the insufficiency is because the exception that is included is only for information that is subject to the Gramm-Leach-Bliley Act and not for entities subject to the Gramm-Leach-Bliley Act, which is really a big difference, which will cause unique compliance difficulties and also open banks up for lawsuits. The second insufficiency is that the model states that the implementation, enforcement, and remedies of the bill will rely on each individual state's consumer protection laws, which implicitly opens banks up to a private right of action in those states which would allow it.
Great. Thank you, Nicole. Let's switch over to accounting. Such an exciting topic, and this is going to be applicable to our credit unions. So let's switch over to them. And Robert, what do we have on accounting?
That's right. So NCUA approved a final rule facilitating the transition of federally insured credit unions, or referred to them as FICUs, to the current expected credit loss methodology, CECL. And so CECL basically requires FICUs to account for loan losses when calculating their capital adequacy, based not only on their prior data, but also on projected forecasts, whereas generally FICUs now are simply relying on historical losses to calculate their capital. But as can be expected with this change, it will likely have a significant impact on the capital classifications under NCUA's prompt corrective action regs. So this rule provides that NCUA will be calculating and phasing in the adverse effects on FICU's regulatory capital to prevent significant drops in capital classifications and all the associated burdens, creating plans to ensure that capital meets the required limits. So like I said, so NCUA will be doing the calculation themselves and will be phasing it in. So that way, hopefully, FICUs aren't experiencing too much hardship associated with this new rule. But just as a reminder, it is effective on August 2nd, 2021, which is definitely coming up fast. So it'll be interesting to see how NCUA handles the calculation and how quickly and efficiently they can implement those transitions.
That's right. And that's not all on capital. NCUA also proposed a rule to modernize their capital adequacy rule for complex credit unions. Complex credit unions are those that have over $500 million in assets, and they're going to help you out, allegedly. So the proposed rule says that they're going to streamline your net worth calculation. So you just have to have about 9% as of January 1st, 2022. And if you do that, if you follow the new ratio and the new calculation, you don't have to worry about NCUA's risk-based capital rule from 2015 as modified and amended in 2018 and potentially yet again at some other point this year. So you don't have to worry about that rule at all if you now start following this net worth calculation. The ratio is going to go up. In 2024, it's going to go to 10%. So you just have to consider the fact that the trade-off here is you don't have to comply with RBC rules, but you do have to have a little bit higher net worth calculations in capital to be considered well capitalized, which is a very important thing because it opens a lot of doors for you to do certain activities. And remember, if you go below the specific calculations, the NCUA or the agency could block you from engaging in certain things like mergers and acquisitions, specific types of loans, like member business lending, and so forth. So this is pretty important. If you are over $500 million in assets, this is a proposed rule that may affect you in the future, and it could actually save you a lot of time if you haven't already started working on how you're going to comply with RBC, which comes into effect January 1st, 2022 as well. So NCUA is also seeking requests for information. That means they want to hear from you, and that is on digital assets, cryptocurrency, which is very exciting. They're basically issuing the same type of request for information that we saw for banks from the FDIC. And they just want to know, do you have any interest in participating in digital assets? Do you currently already offer any types of services, exchange services, or anything along those lines? Are you interested in engaging with fintechs or third parties to do something like that? Maybe potentially utilize cryptocurrency for some type of loans, to collateralize those loans. They just want to know what you're thinking. They want to know if you have current compliance programs, risk programs to measure the level of risk. But I want to note here, cryptocurrency and digital assets is one of those interesting areas that does not operate like anything else that financial institutions engage in. If you think about our ACH network today, if there's fraud, there are steps that financial institutions can take to protect their customers and protect themselves from those frauds. That is just not the same case when it comes to digital assets. They're meant to be a one-way key, and they also are not very friendly if you forget your key. There's not such an easy reset password type of situation here. So NCUA is just trying to figure out, how do we marry what currently our customers do with financial institutions, which is very safe and they have a lot of opportunities to talk about fraud and get their money back, with digital assets that doesn't have any of these safeguards currently in place. So definitely let NCUA know if you're interested at all in participating with digital assets. And I want to leave you with a very uplifting quote from Vice Chairman Hopman on digital assets. And he said he's very excited to see the agency starting to tackle digital assets because he doesn't want to see credit unions become as irrelevant as blockbusters. So that's pretty uplifting. That sounds great. Thank you for that, Vice Chairman. And we're going to move on to our mortgage companies. Nicole, what do we have on that front?
Oh, okay, Stephanie. I just want to say I miss blockbusters, but anyway, we had another statewide, the Conference of State Bank Supervisors. They issued on July 23rd the Model State Regulatory Prudential Standards for Non-Bank Servicers. That's a mouthful. Anyway, this standard, this model standard, it doesn't create any substantive rules, but what it does do is try to standardize mortgage servicing standards across multi-state to streamline it, make it easier for non-bank servicers. To note, within the past 10 years, this industry, non-bank servicers, has went from 6% to 60%. So they have really gotten a big hunk out of the industry. So what we're looking at is the model standard is going to focus on financial conditions and corporate governance of non-bank servicers. If you don't already know, the CSBS also created the nationwide multi-state licensing system, which has really been accepted, nationwide by most all states. One thing also to note is that the Mortgage Bankers Association, they really like this model proposal and they're advocates of it.
Great. That is always helpful to know what the industry thinks about specific proposals. So what do we have when it comes to remote work that may affect our mortgage companies?
Okay, we have, as you know, when the pandemic happened, a lot of workers had to work remote. So there was a lot of temporary laws and regulations that came out to allow mortgage bankers, different people, mortgage correspondent loaners to work from home instead of the branch requirement, which was traditionally you had to work from your branch. These regulations, the different states that did implement it, was done because of the pandemic, but now we have Connecticut making it permanent work from home. So now, in Connecticut, a mortgage banker, a correspondent loaner, you can permanently work from home. The MBA is also an advocate of this. They've put forth a model, work from home bill themselves for us to look at. And I think we will probably see a lot more of this work from home within the mortgage industry, happening.
Thank you, Nicole. And there's nothing better than working remotely. All of my team here today is remote and we're all highly functioning. So that if that doesn't say something about this bill, I don't know what will. But thank you so much for joining us. That is what we have for the month of July. If you need any more information on any of the topics we covered, make sure to check out your Ncomply, which has the latest regulatory changes, guidance, news, and so much more. We are so excited to see you next time and chat about what's going on in the month of August. On behalf of myself, Stephanie Lyon, and my team, Robert and Nicole, we want to say have a great end of your week.
That wraps up this month's Ncast regulatory brief, talking with our compliance experts about the latest regulatory changes you need to be aware of. If you liked what you heard, please leave us a review. And if you're not subscribed yet, we invite you to do so on your favorite podcast platform. Thanks for listening.